How's it going, everyone? I hope you're having a good day today. Recently, the markets are under attack. If you're anywhere within the technology sector, really, especially anything software related, or even part of the CapEx build out, your stock is most likely getting hammered. As we can see here, we have IGV down. This is the software ETF. It's down it's 35% from all-time highs just in October. One of the biggest drops we've ever seen in the entire industry. As you can see here, it has dropped now more than it did during the entire 2020 crash when the COVID-19 virus hit and the entire worldwide economy shut down. So this is definitely a scare. IGV has some of the best business models in the entire world within it. You have a lot of companies like Microsoft, you have Adobe, you have CRM, Salesforce, you have Intuit, plenty of great companies, some of the highest margin, highest retention rate, subscription-based business models in the whole world, and they're all being sold off dramatically here recently. And this is a time when you really have to know what you own. I preach this all the time. If you don't know what you own, you're going to get shaken out during times like this. Things just keep dropping. You don't know what to do. As you can see here today, the Dow Jones is down 1.6%, NASDAQ 1.2%, S&P 500 down 1%. And here's some of my stocks on my watch list. I actually hold a lot of these companies. We have Toast. I hold this company down over 7% today. Duolingo down 6%. MasterCard. Yes, MasterCard, one of the widest moat, highest barriers to entry, highest quality companies that I've ever found. MasterCard down 6% in one day today. Intuit is down 5.5% today. Spotify down 4.6% today. Adobe down 4.6% today. I own all 6 of these companies, by the way. Visa down 4.5% today. I don't own this one. Uber, I own this one, 4.2% today. Hammered. Netflix down 3.3% today. I own that one as well. Microsoft down 3.2%. Copart down another 3%. This one's down a lot recently. S&P Global down another 3% today. I own this one as well. Intuitive Surgical, a company I love, down 2.3% today. Has nothing to do with AI. Amazon down 2.3% today. I don't own this one, but I would love to. Google down a marginal 1%. MSCI down 1%. And then here you have a lot of the defensive stocks. Companies, this is where all the money's going in the market. Everyone's selling out of their tech. They're selling out of their software companies. Anything that's spending a lot on CapEx. And they're moving into these companies, moving into Costco. Great business. It's way overpriced at the moment. Waste Management. This one keeps going up recently. Very defensive company. It's not going to go anywhere. I don't believe it has any risk to AI, but it is a little overvalued at the time. Apple, another one. It's a tech company, but they're not spending any on AI, and people, really, they're a hardware company at the end of the day. They sell phones. That's basically, that's most of their revenue. So people are feeling secure with Apple. ASML, this one is part of the AI build out, but they're not spending so much on CapEx, and the CapEx is benefiting them. So that one's favored a lot. I think this is an all-time high for it today, ASML. If not, it's really close to it. Walmart, another one people are pouring into recently. This one is just everyone's favorite thing now. I believe this company could be flat or down over the next 5 to 10 years from current prices today. Way overvalued right now. It's growing basically with inflation about 4% per year. And it's trading close to a 50 PE. So yeah, basically just people are so scared and they don't want to pull out of the market because they're still bullish on the economy. So they're putting it in Walmart. I guess there is worse strategies than that. But and then lastly here we have PayPal up 5.7% today. I do hold this one. There was rumors that they're potentially looking at a buyout. I don't think that's going to happen, but who knows? We'll see. I'm still bullish on the company going forward. It's one of the cheapest valuations I've seen of any company in the market. But yeah, this is the time to really be transparent. A lot of people, they go into hiding this time of year, especially people online. You know, if they're at their all-time high, they're posting all about it. That's all you see. I don't do that much. But now that I'm near, I think this is the biggest drawdown I've ever had in investing. As you can see, April, I was down 15%. And February was around my all-time high. So I had about a 16% drawdown last April. Currently, I am down. I was up 21.5% on October 27th over on the 1 year. And now I am down a little less, or almost 1%. So I'm in a 22% drawdown from October to February. So that is a 4-month time period. My account has went from $42,300 down to $34,685. Not much has changed in my portfolio. I've actually added a few more positions to this, but I held a lot of these companies during October. I held Google. I had some Meta. I didn't have all this Meta. I didn't have Netflix yet. I had MasterCard. I had S&P Global. I had Toast. I had Adobe. I had PayPal. I had a little bit of Duolingo, and I had Robinhood. So most of these were still in the account. And then I also have a lot of these similar stocks in my Roth IRA. Let's take a look at that one. My Roth IRA is doing a lot better. I held a lot of VOO, which is the S&P 500. I had about half of my Roth IRA in that until about a week or two ago. I sold a lot of it. Or actually, I sold all of my VOO. I still have my SCHG, which is the biggest holding by far, my Roth IRA. I believe this is, yeah, it's a $12,000 position. But yeah, as you can see here on the 1 year, I'm only up 8%. And at the highs in January, I was up about 16%. So still another big drawdown here. 16% down to 7. That's, what is that, roughly 9%. So I'm down 9% on the Roth. I'm down 20% on my traditional account. So I'm probably down close to 16% total if you were to combine the accounts. A lot of companies, Spotify, this is a company I just recently bought a week or two ago. I just started my position. Netflix, I just bought these shares the same time. Meta, I bought 1 share of Meta in here. I bought some S&P Global. I bought some Toast. I bought some Uber. I bought some Duolingo. I bought INTU ADBE. All of these companies I just started positions in or just added to recently. I haven't added to SCHG recently. So, and all of these are down. So year to date, this portfolio is down. But this is the time, whenever you see your portfolio going down, unless something has changed with the company fundamentally, or you truly believe that, you know, the future of this company is bleak, or something has changed, your thesis has changed, you think their moat is getting invaded, you really need to ask yourself, is there something wrong with this company, or is this a buying opportunity? So I wanted to pull up some of these. This is on Qualtrim. As you can see, it has my watch list. It has basically all of those companies that I hold and a few more on watch list. And this is the drawdown or improvement from the 200-day moving average. As you can see, Duolingo is down 64.4% from its 200-day moving average. And let's just look at Duolingo. Has anything changed? First of all, nothing has changed with the moat. They're guiding weak-ish. They're guiding for 20 to 30% growth this year. And now you're getting it at a 24.4 PE, a 7.2% free cash flow yield. And then you look at the charts here. This calms you down right here. I mean, straight up and to the right. Over the past 1 year, revenues are up 40%. Subscription revenue up 46% over the past 1 year. Daily active users, they have 36% more active users today than they had 1 year ago. Monthly active users is up 20% from 1 year ago. Paid subscribers is up 34% from 1 year ago. So everything's looking great. Cash position is great. 1.1 billion. The company is worth less than 5 billion. So you're only paying 4 billion for the company. No debt. $0 in debt. Free cash flow per share even up 48% year over year. Up 73.7% per year over the past 2 years. Everything's up and to the right. A little bit of dilution. They're investing in the future of the company, but it's honestly not that bad over the past 1 year, 0.4%, 2 years, 2.9%. So expenses are going up. Like I said, they are investing heavily, but it's still not as fast as revenue. And the valuation is near an all-time low. I believe, honestly, it probably is since they've hit profitability. Let's see. We don't have to go that far back. They hit profitability somewhere around here. And they were trading at, look at the price to earnings was 643. It eventually caught up. As I said, they just hit profitability, so it was really high at that point. But then it dropped down into the 100s, 200s, and then boom, big sell-off here. After earnings, down to 38. This also had to do with a one-time tax benefit. So this is kind of fake. They're probably close to 60, 70 in this area here. But now we're all the way down to a 14 trailing PE. For a company that is just growing so fast. Let's go ahead and look at another one. Another company, I just started a position in this one, INTU ADBE. I believe I'm down close to 12% already on this company. It took a big hit today, down 6%. There was an article on, I believe posted on Twitter or somewhere else, going over how AI agents are basically going to take over all software. It seems like there's a new article or new presentation from Anthropic every other day now, basically just fueling the fire for the sell-off or rotation, I should say, as the indices aren't that far from all-time highs. But here's another company, so entrenched. QuickBooks, it's over half of their revenue. They have like an 85% market share on small business accounting and bookholding, accounting, tax prep over the United States, small to medium-sized businesses. You're looking at accelerating revenue growth. 1 year, 17%. 2 years, it was 15%. So it's growing faster than it was 2 years ago in terms of revenue. Free cash flow per share up 23%. It's also accelerating from 21%. Look at the dividends, one of the best dividend growing stocks in the market overall. I own another one, MasterCard. And shares outstanding, so you don't have a dilution problem. Balance sheet's fine, 3.7 in cash, 5.4 in debt. Not bad at all. They could pay that off with less than 1 year of free cash flow for the company. Not a problem at all. Let's look at this. Return on capital employed, still looking good, around 20%. This company's fine. It's just being sold off. It's a discount. For me, you're getting a world-class company at a 6.3% free cash flow yield, 4.3 after dilution, and you're getting it at a 15.4 PE. I wanted to buy this company at a 34 PE, so definitely an opportunity for me. Let's look at another one, Toast, another company. This was seen as a company priced for perfection in the 40s. I started buying in the 30s. Now it's at 25, significant discount. Has anything changed? Doesn't look like it to me. Look at the cash to debt. $2 billion in cash for a $15 billion market cap company. Free cash flow, just up and to the right. They recently hit profitability. This is going to continue to go up and to the right. EPS, same thing. They just hit profitability, up and to the right. Dilution, not bad at all. A little bit. It's a younger company. And they actually started repurchasing shares. So yeah, another opportunity. A huge drawdown. As you can see, it's down 26% just since January 1st. Another one. What's next? PayPal, we covered that one on a recent video. Netflix, another one I just started buying. Here we go. World-class company. This one usually trades at like a 40, 50 trailing PE because it's so defensive. People are going to want entertainment in their house for as long as I could think going forward. Total subscribers are now at 325 million. They didn't update this for a couple quarters. That's why it's flat, but this is just not updated. Q1, Q2, Q3 right here. So as you can still see over the past 1 year, it's up 7%, their total subscribers. Revenue is growing at 16% over the past 1 year, roughly in line with the past 2 years and faster than it was 5 years ago. So yeah, net income here, skyrocketing 26%. They're really flexing pricing power recently. Cash to debt looking fine. 9 billion cash, 13 billion in debt. They could pay that off with what? Yeah, almost 1 year could pay off their entire debt load of free cash flow. EPS skyrocketing up 27%. So nothing's wrong with the company. It's just, people want to sell it off, which is fine. I'm going to keep buying. I'm going to, I would love for these to drop even lower in the short term because I'm buying the stock. The lower my average, the higher my future returns. And for the companies doing big buybacks, that amplifies my returns even more. Let's go look at another one. There's so many. My whole portfolio is just getting smashed. Let's look at Adobe. This is another one. I feel like this company has dropped every day for like a year now. It's seriously what it feels like. I started buying around $360 per share. Now it's under $250 per share. I've been averaging down the whole time. I'll probably add again here soon. Trading at a 10 forward PE and a 10% free cash flow yield for a monopoly in the content creation space. Nothing is wrong with this company. Down 26% year to date. Revenue up 10% over the past year. 2 years, 10%. Over the past 5 years, up 13%. So it's slightly decreased over their... look at this growth, though. This chart is beautiful. It's going to continue to go up. Free cash flow per share, it's up 31.5% over the past 1 year. It's a little fake because they had a drop here. But over the past 10 years, it's grown at 24.5% per year. That's the intrinsic value of the company growing at 24.5% per year for a decade. If we even got half of that going forward, this would be a phenomenal investment. Cash to debt's about even, $6 billion of each. Look at the shares outstanding here. They bought 6% of the company back over the past year. With the stock going lower, this number is going to go even higher because, like I said, the free cash flow is going higher. They're going to probably use the same amount, if not more, of their free cash flow to buy back more stock. And the lower the share price goes, the more they can afford to buy back. So return on capital employed 46%, highest it's ever been, by the way. Let's look at the operating margin here, nearing all-time highs as well. I mean, basically in line with all-time highs, maybe give or take 1%. So everything's looking great for the company. Their TPO up 12%, 13% over the past year. Let's look at one more here. What's another one that's everyone's freaking out about recently? Oh yeah, MasterCard. Let's look at MasterCard. This is my biggest holding. It's right there tied with Meta. World-class company. For this company to be disrupted, it would take so much. I did a video on MasterCard alone. You can go ahead and check that out. You're now getting this close to a 4% free cash flow yield. I believe this company, I would buy it at a 3. Arguably, if I didn't have any position in it, just because I think the company's going to do so well over the next decade plus, I would buy it close to 2.5% if I had to start a position there. But I love this discount. I probably am going to have to add some more MasterCard here under $500. That is egregious. Down 12% this year, down 11% over the past year. Look at this. Over the past 5 years, the company's only up 35%. Let's look at the revenue. Over the past 5 years, the revenue has grown 16.5% per year. So 5 years ago, let's pull this to annual. 5 years ago, right here, 16.5%. You're looking at $32.7 billion in revenue. 5 years ago, 2020, $15.3 billion. It has doubled in 5 years, and the stock price is up 30%. Free cash flow per share, $18.8 billion, 2020, $6 billion. The free cash flow per share has tripled in 5 years, and the stock price is up 30%. That is more than a disconnect. Shares outstanding, they're buying back so many shares. I mean, this is close to Adobe, and Adobe is seen as like a dying company. MasterCard's a powerhouse. Their stock shouldn't be selling this low, so they know they have to pour back money into the buybacks. They just announced, I believe, like a $500 billion buyback program. So they're definitely happy with this dip as I am. Even if I'm not buying back shares, the company is. So they're increasing my stake in the company just by buying back shares. Look at the dividend chart. This is one like INTU. Every year, just boom, 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 boom. Over the past 10 years, 16.5% growth. Relatively the same of the past 1, 2, and 5, 15%-ish. I expect that to happen in the future. The dividend yield's low, but if you look at the dividend yield on cost, if you bought the shares 5, 10 years ago, it's close to 3%, 4%. So if you hold for a long time, you have a great dividend return, and the company's growing intrinsically at a really fast pace. So last one here, let's take a look at Google. I still continue to hold this company. I believe it's one of the best companies in the world. It's roughly flat for the year. I started buying this. I actually own shares from 2023, a couple shares, somewhere around here near $100 in 2023. I think I bought like 2 or 3 shares at $104 or something like that. I started buying again in 2025. I bought some in the 190s here. It dropped down to 140 something. Yeah, 144, I believe. Yeah, 144. I didn't buy that at the very bottom. I didn't snipe it, but I did buy shares at 150. I bought them at 160. I bought them at 170. I bought them at 180. It came up here. I bought some more down here at this like 240-ish drawback. And now the company is still up here at $311. I'm seeing a lot of people online starting to trim. I do think that's a viable option as it's not down as much as some of these other great companies. But at the same time, it's really hard for me to sell a company because of this quality, trading at a 27.4 PE with everything they have going with Waymo, Google Search, Gemini, YouTube, Google Cloud. So many things with this company are just, everything is playing out perfectly for them. Their own chips business, everything is perfect. And the narrative a year ago was that this company's, it looks like Adobe did it a year ago where, AI is coming for them. But we're going to see the best business models with the widest moats. They're going to prevail. And I believe Adobe, Intuit, another one. I believe those businesses are going to prevail. Uber, another one with a wide moat. I don't see those companies going anywhere. But with Google, I don't think I can trim my position anymore. If we see another 5, 10, 15% drop in companies like Intuit, Adobe, I might have to take some off the table. I slightly trimmed. I had 24 shares. I now have 17. I sold around 330. I almost sold at the all-time high. I sold at like 333. And now it's down to close to 300 bucks. So I'm happy with that move. But the companies that I bought, as you saw, like the Intuit, Spotify, Netflix, they're all down since I bought them. So it is what it is. But I think those are much better risk rewards from here today. But if you really believed in the story of Google and you wanted to start a position today, I think today is a great time to buy it. You're going to do great over the long term. Sure, we might see 250 in the next few months. We might see 200 within the next year. But I do believe this company will make its way to 500, 600, probably $1,000 one day per share. 15% revenue growth. It has the most net income of any company in the world, and it's growing it at 32% over the past 1 year. 23% over the past decade, every single year. Look at the cloud backlog. 1 year, 157%. The balance sheet's phenomenal. $126 billion in cash. That's bigger than most of the companies in the world. Just their cash position. The debt's not bad, $60 billion. They could pay that off with 1 year of free cash flow. The earnings per share, they buy back shares as well. It's up 34% over the past year, 25% per year for the past decade. Unreal, as I said, they buy back shares. Over the past 10 years, they've averaged buying back a little over 1% of the shares every year. They just recently added a dividend. Cool to see. I don't really care because I want them to invest into growth, but it might draw in some dividend investors. The yield is so small, so it doesn't really mean much, but I expect the dividend to grow over the next 20 years, so this is definitely one I'm going to be holding. The CapEx is insane. People aren't too worried about Google because it is kind of powering the AI, race, as they are like a toolbox for other companies to use. So it doesn't have near as much fear as some of these other small software companies. But yeah, that's it for today. I saw a lot of panic on Twitter and YouTube, so I kind of wanted to just step in and let everyone know that calm down. Don't look at the stock price. Every time the stock goes down, everything that's said about the company is going to be seen as, a negative. If the stocks were going up and to the right for these software companies, all of these AI innovations, everything that we keep seeing, they would be like, oh my gosh, I can't believe the things that this is going to do for Intuit or Adobe or Google or whatever. This is so great. They're going to cut so many costs. They're going to integrate so many new features into their software. But since the stocks are going down, the narrative is simply that it's all doom and gloom, the nearest end for these companies. But just kind of step back. I think this is the best time to really look at those charts. Just look at where the company has been over the past few years. Listen to the management. The management for all the companies that I've been investing in recently, they all sound extremely bullish on AI. I trust a lot of the managements. So yeah, just stay level-headed out there. Know what you own. I do a lot of research. Every company I own has probably received 50 plus hours of research just into that one stock. That's why I only own 12 or 13 companies total. I recommend you to do the same. Stay in ETFs if you're a little too worried. If you're going to get shaken out, just VOO and chill, and you're going to do great over time. But yeah, don't panic too hard out there. If your company is going to get disrupted by AI, I would recommend getting out. But I believe all the companies that I am in and a lot of other software companies out there are going to be just fine. So stay level-headed. Y'all have a good day. Thanks for watching.